Welcome to the Pump and Dump channel for the year-end review of the performance of the theoretical model portfolio. As you can see here, the transactions made since the 17th of June when I launched it. I was obviously more active at the beginning and then saw less and less need to do things, and it is what it is. It's come out with a gain of about 20%. Just to bring up the website here to validate that my stock prices here are accurate. You can see there for African Gold Group, for the Goodyear Tire and Rubber Company, Range Resources here, and PBF is down here, and then also Safe Bulkers down here. So all updated, as you can see at close, 31st of December for all of them. Exchange rate here for Canadian dollars needed for getting this current value, because it is what it is. I have to do it this way. So there you can see that some of these stocks have taken a beating, others have done okay or quite well. In any case, this is the end result for the year, and now I'm going to go into the individual positions still in the portfolio. And I was thinking about bringing up some, making some changes to the portfolio, but I'm going to leave this until I guess until after the first trading day in the new year. Even though I guess I should do it now, but I'm going to do it on the first day in the new year, because I obviously haven't been, the last couple of days have not been really focused on too many things, looking at finding the next entry point in the good stock. I do have one in mind that is going to be, in my opinion, a double from here in the aluminum production, but that's one thing, of course, in my mind at this point in time. But I'm going to now go through these individually and just talk about them. So just give thoughts on how I see them progressing, where I think they should be versus where they are now, and why they are where they are. So African Gold Group, it's down about 45% from when I bought it. The reasons why it is down are quite simple. What happened here is that back in May, I think, or so, in April, May last in 2019, when Stan Barty came on board as the CEO, had this strict timeline of getting things rolling and getting things into production by the end of the year, and that did not materialize. Reasons why the company was not able to raise the money can be found in any reason. Some people say it's because of COVID, and other people say it's because they don't have 1 million ounce or greater reserve, and they are working on getting above 1 million ounce reserve, and that's kind of what I'm thinking will happen by June next year, where they have an updated feasibility study. And if the gold price is still in the I'd say 1750 plus range to 2000, or even higher potentially, then I think they will definitely get financed. But it is what it is at this point in time. I think the current value is at least 50 cents a share. If you use like current gold prices and benchmark it against the peer group, that's kind of where I think it should be, at 50 cents Canadian. But half of that, because they haven't delivered, should be the penalty, of course. Like when a company does not perform, I think they deserve a penalty where they're just trading at half intrinsic value that you can calculate based upon their assets. So that's kind of where I think it should be, at least 25, potentially 50, and I think next year there might be a chance to get in, to get a rally in this stock. And yeah, we'll see how it goes from there. So this is ongoing. I don't see a reason to worry about it, even though it's down 45%. It is what it is. I guess I could have gotten out of it at like 20 to 25 cents Canadian, and then waited and see what happens. But I guess when the upside is there, sometimes you just have to accept that you might have a drawdown, and that's just the way it is. So next year, Goodyear Tire and Rubber Company. Don't know what to say. I mean, the rubber price is good. They manufacture rubber, and then they manufacture tire out of that rubber. They sell rubber as well. It's not just the rubber tires they make. They sell rubber, the barbells or whatever they call of rubber. They sell to clients like oil companies and things like that. So yeah, this company here, in terms of valuation, I think I would say that the intrinsic value is declining slowly because they're not performing, and that's why they're trading at half of what I thought they should be at. I don't know if this can exceed $11 by too much in the near term until they start, let's say, performing better. But there is the potential there that they will get towards 19 within a year or so. And apart from that, I really have nothing to add here. I mean, it is what it is. Next one here, Range Resources. Yeah, this is the most interesting company. This, I could have put my money into CNX and done better recently when I bought this here on the 31st of August. I could have done better with CNX because CNX is obviously delivering. I mean, I have it in my personal portfolio, but in terms of the upside, I just think that Range Resources has a far greater upside going into the publication of the Q4 earnings report, and potentially with the annual report coming out around the same time, it could lead to what I think is at least a double from here, potentially a triple. So it's at 670 a share. I've talked about this one extensively in terms of how the market prices it. Was the natural gas liquids being priced as as oil was a discount, and for 2019 the oil price was around, I think it was around 51, or maybe let's say 50, and the natural gas liquids were around 17, and if I'm correct, I think the oil price for this year is about 41 on average, and for the natural gas liquids around 23. If we look at this in terms of a ratio, you can see here quite clearly that the ratio has increased. So my theory here is that when we get into the publication of the annual report, they might lose some barrels of oil in their reserves, but their natural gas liquids value will increase because of this ratio increasing, and because most of their reserve is natural gas liquids, that will lead to the value of their reserves just increasing in terms of how the market is valuing them. So that's the strategy here of thinking that this is something that can happen and will happen, and that is the reason why I'm so bullish on them. And also for Q4, the earnings report is going to be, I think, relatively outstanding because of the fact that in Q3 they under-earned their potential by I think they shut in some production, or they curtailed production, whatever the technical details are, but they didn't produce as much as they could. And instead of producing it, they sold forward some contracts for Q4 at higher prices, and that's kind of what they have, where the volume has gone of the production. So I think once the volume comes in, they produce the higher volume and they have the greatest sales, they have a good earnings report, and then they have the annual report where the reserves could, not necessarily increase in terms of how they report them, but in terms of how the market values them, it could increase, and that would ultimately lead to a double, potentially a triple from the current point in time where we are right now. So that's what I'm thinking. And then next year, PBF Energy. I bought this when I sold Diamondback and Alliance Resource Partners. I think I mentioned exactly like what the reasons were why I was selling these two, and that had to do with fundamentals relating to the sectors, individual sectors, and I thought that because of the high correlation, PBF would perform as strongly as Diamondback, but it has not performed as well as Diamondback. Diamondback is around 48, I think, dollars a share, and PBF is only at 710. So you can see it's up 40%, and this is up like more. So yeah, Alliance Resource Partners, I have gone into my thinking here. I mean, it reached 5 plus recently, but it's starting to go down again. It's like 460, I think. And I've looked at their earnings potential, and the earnings potential is there to get to $10 a share. This is kind of what I was talking about when I first bought it, and it reached $5 like I thought it would. But in terms of its earnings potential, it's not necessarily clear to me how they will how should I say, how they will achieve that in terms of what their guidance is for next year. It just does not seem right, and I don't know if they will really achieve that. So we'll see what happens. They should do better if the oil and gas reserves that they own the royalties on, if they are produced, and they should have good earnings and should be good. But with coal, I'm not so sure about this, and especially with natural gas looking forward at around 260 long term, I just don't see necessarily that they will do that well. So that's kind of the reasons why I went to PBF Energy, because I think that a refiner will always be needed to refine oil into heating oil and gasoline and jet fuel oil whenever it's needed. And the performance has, it has been as high as I think 860 or so was near the highs recently, and I mean I was selling some in my portfolio at 860 and shuffling into other things like Range Resources at 7 something, because the opportunity was just there to take advantage of it. And anyway, here in this portfolio here, it's just there. It's a core position like all the others, apart from African Gold Group, which is not necessarily a core position. But anyway, it is what it is. It's there. The earnings potential is there. The increase in oil and gasoline for the inventory they still have is there to drive that higher. So I think going to Q4 we'll see what the closure of Paulsboro refinery has achieved for them, and the I think the Martinez refinery they acquired at the beginning of the year from Shell or Total. I can't remember who it was, but the one they acquired there, I think that one's up and running. So we will see their true potential earnings power potentially in Q4, and that should, in my opinion, take it at least to $10 a share. So we'll see what happens there. Next one here, Safe Bulkers, which is also a very interesting play on the dry bulk market. We see iron ore currently at $155 a ton plus, and that's very important. There is, I mean, I've read that there is a shortage of iron ore, which is surprising since the Earth's crust has, really high abundance of iron ore. So, why there is not enough iron ore, I don't know. I mean, the steel mills, if they want to produce more steel, they need more iron ore, obviously, and coal as well, metallurgical coal. And if you think about it, if the coal price is high, what will the producers do? They'll look at increasing production. But from the safe bulker or the dry bulking space, looking at it from there, the idea I have is that either demand will increase and there will be more vessels built, which is interesting because the vessels are built with from iron ore. So if iron ore is needed more for other things, and then you need also iron ore to build more vessels, it kind of like perpetuates the rally kind of. It's kind of the rally in demand, let's say. It's kind of strange, but yeah, either it leads to an increase in dry bulkers coming online, or, and this is what I think is the more likely scenario, is that rates for dry bulkers will rise, because at some point the iron ore producers will say, we need to get our product to market. We're getting $150 a ton. We only used to get 60, 70, $80 a ton, and now we're getting 150. We need to get it to market. We have to just pay through the nose to get these dry bulk ships. If we pay them 10,000 or 20,000, doesn't matter, a day. We need to get these vessels and get our iron ore shipped out, and that's kind of where then the pricing power comes from the existing fleet, because the soybean producers and all the other bulk producers, they will look at this situation and say, hey, we also want to ship our goods. And when there does come a point in time when there is not enough supply, or when one producer of one product or commodity in this case decides that it's worth paying more to get that security of having a vessel to ship your product to market, then the rates should rise, and that should lead to an increase in the valuation of the stock. So that's kind of how I see it for these positions. I could go over the other ones in the portfolio, look at what I see for them, but I could also talk about other companies. I mean, I have just these few numbers here, and these few stocks here, but I know a lot more companies pretty well to make a judgment and assessment on, in terms of what the valuation is, what their outlook is, and that would take a lot of time. So we'll see going into the new year. There's there's quite a lot of interesting companies out there that should be benefiting from the rise in certain industries and sectors, from the rebound, of course, from the meltdown. But there are obviously only so many positions you can have, and I think at some point I'm going to have to restructure the portfolio and increase the size of stocks. I think I think like if I put in a limit of 2,000 per name, and whenever it gets like the 3,000, as you can see with PBF here, I could say, okay, I need to take 1,300 off and put it somewhere else. I think that's something I should do going forward, and probably will, but on the other hand, I think it goes much higher, so I don't want to sell it. So yeah, that's the way it goes. I'm not sure I included these dividends here. I think I include them in this performance here. I think so. Let's see. It's U20, no, U16. Yes, it's there. Okay, so yeah, that's going to end the review here. Next thing is, of course, here I've put in the copy this here and paste this here. That's what happens when you change the exchange rate from a higher number or lower number. You get a different result. So yeah, this is kind of where it's at. So we'll keep this in mind, that over these 6 months, 20%, and I think I'll keep making videos on occasion, changing some things up when I see something just staring me in the face, that something needs to be sold and something needs to be bought, and then I'll continue this going forward, and then we'll see how it goes for 21. That's what I'm thinking for now, at least. So anyway, I'm gonna close this here now, this video. Remember, if you have any questions, comments or opinions, you can leave them in the comment section. You can also subscribe if you're interested in following the performance of the portfolio, and as always, you should never take this as investment recommendations or advice. As you can see here, like my last video was on the 11th, no, not the 11th, the 4th of November, and there could be things happening that lead to something being justifiably down and turning into a sell. And therefore, if you like say, hey, he has some safe bulkers here, let's buy this too, he told a really good story, let's buy it now at 130, and then 3 weeks from now it's at 110. It's like, what are you going to do? What are you going to do? Are you going to say that I was wrong, or are you going to say that it will work out eventually, or you're going to buy more, double down? Who knows? But anyway, that's it for this video. Gonna close it out. So remember to do your own research, and if you can't do your own research, I mean, there are some people on YouTube who do some portfolios and sell like their access to their research or access to their portfolios or whatever it is, and some of them don't know what they are talking about. Some of them are just really good salesmen. You have this always in the investment industry. It's not necessarily about how good of an analyst or portfolio manager you are. It's about how good of a salesman you are, because you need to build your book, you need to get your client base, and No one really cares if you make 20% or 7% or 85%, as long as you bring in the money to the investment manager or to the bank, bring in the clients with their money and charge them fees against it. That's all, you know, these people are looking for. They're not looking for someone who performs well for their clients and grows their portfolios and ultimately leads to greater fees for the company. They just want some people who can talk people into parting with their money and get that money right now. And that's unfortunately, the short-term way of looking at things, and that's why you have a lot of people who I mean, I always say these stories about Peter Schiff, that people who invest in his funds are just melting. And I don't know. I mean, I've seen some of them have done really badly, and it's not, like personally against one guy. I mean, I see this with major investment managers who have like a reputation. Like in the German market, they have, I think it's Allianz or Deutsche Bank. One of these two has, I think it's Deutsche Bank actually, which has all these ETFs, the DB Advisor ETFs, and if you look at them, the charts like over 3 years is starting at 100 and then it's down at 10. It's kind of how their charts look for many of their ETFs. And I mean, if you look at the prospectus, you can quite clearly see that they can't necessarily work, for you to make money. And of course, there are, some vehicles that are constructed as a way of, you lose money, and as a consequence of losing that money, you save money on taxes somehow. And these structured products are obviously great for the people who are selling them, because they're like making gains off of other people losing money, and somehow they manage with the tax code to get out a little gain for the other people too. So it's kind of like a win-win from their perspective. And yeah, I mean, I'd rather make money and pay taxes on them than lose money on something and let someone else make a bunch of money off of me, just so I can have some losses to report against the income and come up with a lower effective tax rate or some nonsense like that. So that's just me. I'm going to end this video here. So that's going to be it. Have a good day.